Good morning.
Good morning. Can you hear me?
I can hear you. Can you hear me?
I can hear you. Good morning, everyone. First Hand Trading. How are we doing? Today is Sunday, March 3rd, third month of the year. We're rocking, we're rolling. Glad to be here. Got my Starbucks coffee. Good morning, everyone. Aiden, Axel, Florine, Pops, Ron John, Sarah, Stuart. Hope everyone's doing all right. Happy Sunday.
Happy Sunday.
Hope everyone had a good weekend. Had an insightful week in the markets. This week could be pretty insightful as well. Who's surprised that we kept going higher? Did Friday surprise anyone? Did Friday raise some eyebrows?
It's a fun day. One-way train. Aiden fell asleep at my desk.
It's funny. I remember on one of the last calls, Sarah, one of your questions. I think it was last Sunday call. We were talking about what is spooling. You had a little bit of spooling on Friday. So if you can remember Friday's price action, a lot of that was mostly just spooling. Once you got into the lunch hour, you had a couple areas for entries, but yeah, I think a little bit is an understatement. Yeah, it spooled high very quickly. So very cool, very cool.
We got close to that 18,400. Just shy. 27.25 handles.
Good morning. As people are piling in, we'll start in just a second. Sufyan, Steven, Terry. Good morning. Good morning. Is it Sudharshan? Hopefully I pronounced that correctly. Good morning. Good morning. Good morning. Good morning. Good afternoon. It could be good afternoon. It could be good night, wherever you are. Excited to get into it.
All right. Guess we can go ahead and get started.
All righty. Shall we? News? You know that's where we start. So this week should be very insightful with regards to what exactly we might end up wanting to do to really start out the month. There's no news on Monday, but it is NFP protocol week. What is NFP proto week, Carson? Well, as you can see down here, we've got this non-farm unemployment change, right? NFP Friday, the first Friday of every month. Obviously, last Friday was March 1st, but we had the leap year. So this is really the NFP protocol week. And what that says is basically that first half of the week, basically Monday, Tuesday, and then Wednesday until noon is going to be your high probability trading. Anything else is going to be considered low probability, and you endure what is potentially called seek and destroy templates, where when you are trying to learn how to trade ICT concepts, if there's going to be one nemesis or one enemy that is going to go against everything that you're trying to study, it's the idea behind seek and destroy, because seek and destroy has no regard to anything internally, any PD arrays internally, and we'll talk about that. But your higher probability setups this week are going to be on Monday, Tuesday, or Wednesday until noon. Now, on Tuesday, you do have ISM services PMI. Monday, there is nothing. So there's no news on Monday, but that is okay. It can still set up for clean price action on a week like this week. Tuesday, 10 a.m. ISM services PMI. That's all we've got going on for Tuesday. On Wednesday at 8:15, pre-equities open. You do have non-farm employment change by ADP. And then at 10 a.m., you have the Fed Chair Powell testifying, right? Testifying is a lot different than speaking. So understand that. You have Powell testifying at 10 a.m. and you have JOLTS job openings at 10 a.m. So I would say 10 a.m. on Wednesday would be somewhere that you would potentially want to utilize just to at least study. Don't have to be a trader, but at least study what happens in and around that. This is more of just an instant release right at 10. This can lag a little bit as he testifies throughout the whole hour. It can be lagged, so you just can have this constant injection here and there throughout the entire hour. So that's on Wednesday. And then we want to note that anything after Wednesday at noon becomes low probability. The market enters what we potentially can see as seek and destroy, but we still want to study. We still want to potentially be a participant, in demo if that's the case, but we want to try to remain focused on protecting our live capital at all costs. And if that means not trading in low probability circumstances, that's what we'll do. So Thursday at 8:30, we have unemployment claims. At 10, you also have Powell testifying again. Back-to-back days on Powell testifying, right? This week could potentially, even though we had a very large range last week, right? Large ranges create small ranges and small ranges create large ranges. Well, note that even though we might be expecting a small range this week, that might not be the case with the idea that one, it's NFP week, but two, Powell's testifying back-to-back days, right? We're coming up on the first quarter close, right? The first quarter will be closing in the next month or so. So, keep that in mind. So Thursday, 8:30, you have unemployment claims. At 10 a.m., you have Powell testifying. And then at 11:30, you have FOMC member Mester speaking. On Friday at 8:30, all being released at the same time, you have the average hourly earnings on month, NFP employment change, and then an unemployment rate. Now, yes, you guys have seen, I remember a couple weeks back, we had an NFP day where, there are trade opportunities that are seen and can be taken advantage of. When I'm speaking towards the idea of not trading the back half of this week, I'm talking to that trader who is not found themselves quite yet within their journey. If you have been trading for years and you have a very sound, solid model that you follow, and you know exactly what you're looking for when you're looking for it, and you see something on Friday, that's on your own risk, right? That's not me to tell you what you can and can't do. But as a beginner, what I'm trying to protect you from is very, very high volatility instances where you might not be able to react and think logically in the moment. And again, like I said, seek and destroy template also, right? The market tends to go into that. And if you don't know how to navigate yourself through seek and destroy templates, it's very hard for you to become a profitable trader in those instances. So what do? Well, we watch, we study as a student, and we say, you know what, if we are going to press that button live or at all by any means, I'm going to do it on Monday, I'm going to do it on Tuesday, or I'm going to do it on Wednesday in the AM session. And other than that, I'm going to sit back and I'm not going to necessarily try to trade the back half, and I'll study it and see if there's anything that I can get. And I don't care what he does or she does or all that. I'm just going to focus on myself. I'm going to protect my capital because that's the main focus at hand. Any questions, comments, or concerns on news? Does all that make sense? Usually you guys are pretty good with news. All good. Okay. Let's go into dollar. And I want to touch on a couple things here, right? The dollar's been consolidating. We have not really gone anywhere. And as you can very well know, indices have been going higher, right? We've been going higher with no room for really looking down, right? We've been very bullish on indices. Dollar hasn't gone anywhere. And I really want to set this as the precedent, right? Just because we are at all-time highs in indices does not mean that we look to sell. And there's a couple reasons for that. One, if you think about it, when price is in all-time highs, it has no premium arrays. Think about this. It has no premium arrays that are there to stop it, right? It's actually easier for price to go higher, right? Don't get fooled. It's easier for price to go higher. Yes, price will eventually get exhausted and it'll get a little overextended, but you have to note that there are no premium, there's no SIBIs, right? There's no higher time frame SIBIs that we're waiting for it to deliver into, right? It's straight projections. So you have to understand that and view every initial lower price action as only a retracement. Also note this on dollar. If you look at dollar on the monthly, we have pushed into this SIBI, right? We have rejected the consequent encroachment of the monthly SIBI very cleanly. We've closed below the SIBI as well. And so far, if I'm looking at this as on a 1 minute chart, on a 1 minute chart right now, I'm immediately going to sit there and I'm going to start to assume that, hey, we could pull lower, right? We could pull lower into these lows potentially. If price is going to respect this monthly SIBI and price is going to start to go lower, what would that mean for indices? Once we do, because we aren't necessarily in a full trending market yet, because dollar hasn't displaced in any way. We've been consolidating. It's been hanging around. So if you think that, oh, just because of this high run last week, we might go lower. Well, what if dollar starts displacing lower? Right? That would mean that potentially indices should still deliver higher, right? So I want you to keep that in mind. Just because we are at all-time highs does not necessarily mean that we go ahead and we start looking for bearish prices. That is not the way you need to view this, right? You need to understand what could unfold, but also go with the market, right? That trendy or that corny little saying, the trend is your friend, is very key, because if dollar starts to fall, indices are just now getting going on the upside. Keep that in mind, right? So that's something that I want to note, but I do want to note too, though, for potential upside, right? Keep an eye on this previous month's high, because you do offer the idea of an immediate rebalance. In here, price could use this high and then go and visit more of this, right? That's totally acceptable too. Really, that's it on the monthly. On the weekly, same thing, right? So last week, we touched this monthly SIBI again. Previous month's high. We came lower, but we're still ranging, right? We're still ranging. We did not take out the previous week's high. We did not take out the previous week's low. Inside range, right? Smaller ranges create what? Larger ranges. So we're expecting, I don't know when, but I'm expecting dollar to eventually expand into a higher range and displace one way or the other. I do not know what direction that is yet, right? So if I do not know, I need to continue being neutral, continue to wait. There has been no displacement at all with regards to this. Where did we close last week? We closed just above the consequent encroachment of this weekly BISI. So we're still respecting this discount array in the form of a weekly BISI. So as long as we close still above this, price still can go higher. And with that, we might see indices go lower. But until I see something, I'm going to remain neutral here and keep my main focus on the indices and just in when and how they're moving on a daily, right? So if you look at power of 3, with regards to February, we consolidated, we opened, we manipulated lower, we came off, right? We manipulated lower, expanded through the monthly open. We tested that monthly open once, and now we've kind of came back off of that, right? Notice how we've respected the previous month's high. We are in the middle, right? We're dead in the middle, right? From this low to this high, you can see where the equilibrium is, right? Right in here. We are dead in the middle. I am dead neutral on this asset class right now. If you had a gun to my head and said which way was it going to go, I was going to tell you, I don't know. Because higher time frame, we're delivering off of premium arrays. But on intermediate term time frames, we're respecting bullish arrays. I don't know. I need it to show its hand. We're not displacing lower. There's been no displacement lower. There's been no displacement higher off of any of these. So what do? We wait. We're okay with the fact that we don't know. We're not going to know what the market's doing 24/7, right? And if anyone will sit there, if I sat here every single week and came to you and told you I knew what the market was going to do with full confidence, I would be lying to you. I would be doing yourself and myself a disservice. I do not know what this market's going to do. I am unsure. I'm going to wait until I see clear displacement in one direction, higher or lower. And from that, I can start to build a narrative. Until then, I sit, I wait, and I watch. And I keep my main focus on indices. And I act as if indices don't have any correlation at all to this until it starts to actually have it again. Will it? Yes. Yes, it will again. It just is not ready yet. Any questions, comments, or concerns on dollar? Does all that stuff make sense? As to why I would be waiting. Right? There's no reason to stress yourself out in this scenario trying to sit there and pick a direction because you're gambling. It's a guess. And it's not even an educated guess because you don't have enough information or data to back it up. Let it show you displacement and then pair that with what the indices do following it. Once you start to, like I said, if we start displacing lower, indices could just now be starting a run higher. Right? And I remember a couple weeks ago, we were talking about in the chat. I remember a couple of us were talking about it, some traders on Twitter, and I'm not going to mention any names, but some traders on Twitter were talking about how NASDAQ was about to fall. And this was before last week's price action, and I think the week after that, we were talking about how people were already starting to call tops. I'd love to see what they're thinking now. They're probably still going to try to call tops. This is why we don't. And this is why we've remained bullish, right? If you guys have been with us for I don't know how long it's been months. We have not hopped on a call in this Sunday call. We have not hopped on a single Sunday call in months with the idea of in the forefront of our analysis on indices being bearish. It has all been bullish. Despite what dollar's been doing, right? There's weeks where we're a little bit less uncertain. There's weeks where we go a little bit more neutral. But at the end of the day, we have not leaned toward any bearish price action. And we viewed every single lower price, every single lower delivery and price on indices as what? A retracement. To then what? Go higher. So keep that in note, right? And that should be a testimony to you as to why we do that. Just because you see a high run in price does not mean that it's just done, right? It's very quick and easy to just try to call a top, and you will get hurt. You will get very hurt trying to call tops and bottoms, right? So keep that in the back of your mind. I'll go ahead and pass this over to Henry to go over indices.
Okay. Get into ES and NASDAQ. So like we talked about on Friday in the morning chart and chat, we were utilizing the prior month's high and prior week's high as well as buy side liquidity for price to trade up into, which we got that nice move on Friday, continuing up through the buy side of the prior month's high. And now we've started a new monthly candle. So here we have March opening up. And like we talked about on Friday as well, we want to really start using the first week of this month, just like we use a Monday in a regular trading week, a Monday and Tuesday in a regular trading week, to start framing how the monthly candle could develop. Because if you see manipulation in one direction, then you can potentially see a move in the other. So if we're forming an early manipulation higher to run out buy side, then you could see price dropping down back into this area of inefficiency down here. If we're going to have a extremely bullish month and just run, then you've already had manipulation below the lows. And just like we talk about with the daily, price action when you have a small manipulation like that around your midnight opening price. You could potentially see a large expansion day. So the opportunity is there as well for March to continue higher, higher, higher. And just like Carson said, we're not trying to call tops or call bottoms. We're just operating within the current order flow. And all we have seen since November is bullish order flow. Higher, 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 higher. There's no reason to fight against this. So still, even at all-time highs, your best opportunities, your largest expansions, your highest probability trades are going to come with the higher time frame order flow, which means we're still looking for higher prices to trade. Okay. We just want to be aware of the inefficiency that exists below as an area that price can retrace into if we start to see violation of discount arrays on the lower time frames below the monthly, so your weekly and daily charts. So we'll note the inefficiency that exists here. On your monthly chart on ES, you have a BISI down here between this high and this low, another here, okay, and then you have this area of inefficiency that's not a fair value gap yet, but it is forming an area of inefficiency. And so upon the closure of this March candle, you could have a new fair value gap here if we continue to expand higher, or March can come back down and revisit the high from January and do an immediate rebalance there. And then from there, either continue working higher or trade down into deeper discount into the inefficiency here. And so in order to see if this area will be fully traded and for March to trade back to January's high, we go into the weekly and daily charts and see what PD arrays exist in price between these two areas, between the low here and the high here. So we go down to our weekly and daily, and then we see, are those PD arrays being respected or violated? Which basically means, is candle closure supporting at least the midpoint of those PD arrays? If so, then we can just continue working higher. And if it closes through the midpoint of those PD arrays that are below price, then we can work back down into January's high here. Okay. So I'll go to a weekly chart and just look at what PD arrays that we have. So this is the bullish order block we've been talking about. Here we had the weekly immediate rebalance before running up to the prior week's high right there. And so now if you're looking at what discount arrays exist below price, you'd have this candle's wick. Okay, so when we open the new week, you can trade down into this candle's high, the previous week's high, and into the wick here. You also have a discount wick here, and then you have your bullish order block. So I would still be referencing this as the bullish order block here. So you want to take your mean threshold of this. So put your fib on the high down to the low. That, and you'll find mean threshold right here. And if you're seeing closure on your weekly candle below that, then we can continue down into the prior month's high. And then deeper than that, we could continue down into this area of inefficiency down here on the monthly. Okay. As long as you're continuing to see respect for the down close candle right here, then we should continue to see higher prices, which means there's no inefficiency above, but there is liquidity being the high that was formed this week. So you can continue trading higher above this previous week's high right here. As we drop down into a daily chart. Oh, go ahead.
One question I had,
Go
Henry,
ahead,
if you go back to the weekly chart where you were explaining like on the monthly, you don't want the body closure to be below the CE of that monthly FVG. So when you're looking at the weekly order block, uh, uh, the closure of that particular body, is it on the daily time frame or which time frame? Just to understand this concept, because this is an important concept for me. I get lost between the higher time frames versus closure of the body. In which time frame am I particularly looking at?
When I'm looking at closure through a midpoint or part of a PD array, I'm always looking at the same time frame and at the minimum one time frame below that.
Okay.
So if I'm looking at a weekly chart, my greatest focus is, are those PD rates being respected on a weekly time frame? So by weekly candle closure. But I'll go down to the daily chart, as far as the daily chart, to potentially get an early understanding of if it's going to be respected or not.
Okay. Got it.
Yeah. But typically you want to view it from the same time frame. Yeah.
Thanks.
Yeah, sure thing. So daily chart, working inside the BISI right here. I'm going to go ahead and remove this as well. So working inside this inefficiency here, and we've continued to trade away from it. You could see that on Friday, look where we made the low, we came back down into the inefficiency one more time, the high end here, and traded into the last down close candle right here, treating that as the bullish order block and working higher into the buy side up here. Okay. So now, when the next candle opens on Monday, you're going to be opening up in here with inefficiency between Thursday's high and the opening price, most likely, unless we have some wild opening and open down here or something like that. Then you're likely going to open somewhere around here, and you'll have inefficiency between that opening price and Thursday's high. So that full area would be able to be traded into again, okay, down to Thursday's high. You can see an immediate rebalance, and it can continue higher. If it's trading back and closing back down inside the inefficiency again, and then you'd watch this candle here, the last down close candle. If you're trading and closing through the mean threshold of that, then you can work back into the discount end of this inefficiency down here. Okay. So just watching this down close candle and watching for inefficiency that's established inside of here. Because if we're going to see a really bullish week and not even come back down into this area, and March will just continue to expand, then in that case, you could see Monday consolidate, for example, Tuesday or Wednesday drop down into whatever part of the inefficiency remains and utilize that to trade higher. Okay. Or if you see Monday consolidate and then Tuesday and Wednesday trade and close through the low end of whatever inefficiency forms, then you can work back down lower as well. So we're utilizing the new PD arrays that are being established within this range to give us an indication of, can we continue trading higher, or are we going to see some sort of retracement back down toward the lower end of this inefficiency? You have the mean threshold of the bullish order block from the weekly chart, and then you have your monthly high from January as well. Okay. So basically all that we're doing intraday is identifying these PD arrays. So you'd identify this area of inefficiency, and you'd identify the Thursday's high for an immediate rebound, potentially on Monday. You'd look at the down close candle here, and then you're just waiting until price trades into one of those areas. And either when it trades into it, it will create new displacement to the downside and continue trading through it, or it will create new displacement back to the upside and will continue following the bullish order flow. When we're trading at all-time highs, I'm not looking for shorting opportunities. And so while we could see a move back down into this area, I would only, at the moment, be treating it as a return into discount arrays. And I'd be waiting for that new displacement higher and then participating to the long side. So not trying to call any tops on this. We just want to note the areas of inefficiency and the PD arrays that exist below, wait for price to trade into them, and then create new displacement away from that. And then we can find a way to jump on the train there. Okay. Any questions here on ES? Or I'll go to NASDAQ. Check the chat as well. Sarah, all good. Ron John. Good. Stuart. Okay, Stuart, yes. Awesome. Okay. And since we have NFP, Monday could be decent price action. Normally you are on NFP Mondays, those are the Mondays when you can look to participate rather than on your typical Monday of the week. Stuart, please show current PD array. So in terms of what we're looking at on Monday, the PD arrays that would exist below would be this prior weekly high from last Friday. So that's an old high. That would be your first PD array. Your next would be the immediate rebalance here being Thursday's high. And then the next would be your consequent encroachment of the wick. And then next would be the down close candle here. These are all PD arrays that exist below price. So you could look at your range like this and see where discount exists. And then if price was to return into a discount down here, okay, 5,104 3/4, then you could have nice buying opportunities from there. If we're going to see a really bullish week though, then it may not even necessarily need to return that low. So you just want to be aware of the PD arrays that exist between there as well. Okay. That helps, Stuart? Yeah, okay, good. Sweet. All right, are we all good on ES? I'm going to go to NASDAQ. Looks good. Okay. Okay, all the same things on NASDAQ, really. So just watching for the same ideas. You have a BISI down here on NASDAQ, and you have the area of inefficiency that we're starting March with here as well. Okay, so price could in March trade all the way down to its January high, being an immediate rebalance, or we could see further expansion away. And if you're trading back through January's high and creating new displacement down through that high, then you have inefficiency here to work into. So I'm always following that displacement. That's giving a good indication of where order flow is going. Okay. From a higher time frame perspective, again, we've just been bullish, 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 bullish. There's no reason to fight against that and be looking for a top to be put in. Okay, no reason to do that. On a weekly basis, you can see how we traded from the BISI down here, and reclaimed it right there. Trading higher. And then just like we talked about on ES, utilizing the down close candle here as the bullish order block to trade away from. With order blocks, if you're going to trade higher and utilize this range to identify the change in the state of delivery. So here we're having sell side delivery, and then as we trade through, you have buy side delivery back up to the upside. It just needs to trade through the opening price of this candle here. It does not need to go and close above the down close candle in order to start using this range. What's important is that you're in line with the draw on liquidity, and then you don't have a reason for price to return lower. So here we've already traded inside the inefficiency here and here on the weekly basis, and the monthly inefficiency that exists below that is down here. So if it's not going to return into that area of monthly inefficiency, then you can continue going higher, and down close candles should continue to support price. And so here on this candle, right when it trades above the opening price, it just needs to go one tick above the opening price of this candle. Then it can start to be treated and respected as the bullish order block. And so here you can see on the prior week, right there, if you look at your range of this candle and look at the mean threshold, you can see how it's respected right there. Okay. Utilizing the mean threshold and then trading higher. So you can continue to use this candle here as your bullish order block to see price move higher if we're going to continue that bullish order flow. All right, and in that case, we'd reach for this high that's been formed up here, being buy side liquidity. Okay, so still continue to monitor this candle here, the high, the opening price, and the mean threshold of it. Okay. On the daily chart here, you can see that not only did we respect the mean threshold right there, but also the consequent encroachment of the daily BISI. Okay, really nice. Drop down on Monday, Tuesday, and Wednesday. Thursday reversal, trading through the prior day's highs from the week and reaching up into the buy side above here. So when we open on Monday, you'll have an area of inefficiency here between Monday's open and Thursday's high. You also have a small BISI that formed in here. Okay, so you're still seeing new displacement to the upside, which means that's a really good indication of bullish order flow. Remember when we talk about if we're expecting that price is going to trade from an inefficiency, trade higher, and then retrace lower, we'll likely see that if a new inefficiency is not being formed on the way out of it. But when price trades into an inefficiency like this and then trades higher and creates new displacement on that same time frame, the likelihood is that we can continue the order flow. So I would expect that going into this next week, we will trade higher than this high. Okay, trade up through the buy side up here. And then in terms of discount arrays, you just want to watch for the overlapping high here. You have a volume imbalance and the BISI right there. And then you have this down close candle here on the daily. And from your weekly perspective, you're watching that weekly bullish order block. Okay, the high, the opening price, and the mean threshold. All of those treating as discount arrays. And so just waiting for price to trade into them and then continue to displace higher. On your 4-hour chart, your hourly chart, your 30-minute chart, that will give you a good indication that bullish order flow can continue. And then when price returns into those areas of new displacement, you can find an opportunity within your personal trading model to go long and look for the buy side up here. That makes sense, everybody? Any questions on NASDAQ? Jengiz, I see your hand. You can go ahead. All good. I see your thumbs up too. If you wanted to come on and ask a question, you can. Okay. Looks like we're all good. Okay. Sweet. Then I guess we will. Oh, no worries, Jengiz. We'll jump into training exercise.
All good there. All righty. Let me pull up the Discord. Okay. So this week's training exercise is a little bit different. We wanted to understand what your plan is as a trader, right? We gave you a couple of things of what to potentially add into your trading plan. We wanted to see 3 examples also. So we'll go ahead and get into it. So Terry, first one to submit it. He's looking for weekly and daily highs and lows and inefficiencies. On lower time frames, he's looking for 4-hour and 1-hour inefficiencies. And then he has this 15-minute fair value gap indicator that he toggles on and off. He tries to enter anywhere from 3 a.m. to 5:15 a.m. At times, I will have to look at charts throughout the day, throughout his workday. POIs, so he's looking for inefficiencies, highs and lows of Asia session and London's range, as well as the consequent encroachment of those ranges where nearby liquidity has not been reached. His entry model, he usually likes to enter at the consequent encroachment of gaps and ranges. Main entry time frame is in and around the 5-minute time frame. He also likes the 618 retracement of ranges, the optimal trade entry. His risk management, stop at a swing lower high or up to 20 if one contract. Will look at a 1 minute to reduce stop if possible. So he's looking at that most recent swing high or low up to 20 handles, and then stop at 10 points or 2 contracts as well. So he's cutting that in half if he doubles up on contracts. Trade management, he tries to let price hit targets. I will close trades if the current 5-minute candle closes above/below previous, if long or short. Reflections, I know my model works and need to act and not react. Many times I have not acted to miss a trade. I then react at an entry that is not favorable. I get stopped out to see if price move to targets. Moving to one contract or 5 minutes would be advisable, as it would reduce the fear of being wrong/taking a loss. With Carson and Henry's input, I've noticed that I'm becoming patient, letting the trade develop and beginning to improve on the act portion of it. Side note, I do not get to tune in for all the morning chart sessions, but what I have been able to attend is a big help. So first, right here, right? So a lot of things going on here. Daily long bias. Asia range is the purple. So he's looking to see price hit consequent encroachment of the daily fair value gap after expansion from Asia range. Entry short at 1748. So it looks like he is going Oh, okay. So I'm assuming you're longing or you're shorting in here, somewhere in here. I'm not exactly sure where. This one I can see a little bit better. Long bias, price hit the consequent encroachment of the Asia range. After retracement range, entry long at 17,006 above 5-minute consolidation range, above 1 hour fair value gap. Stop 10 points just below midnight open. Target 1 is the 15-minute fair value gap. Target 2 is the full retracement to London high. This would be no trade as 8:30 news. So I'm a little confused here as to where you're entering and exiting on. I can kind of see this. I would say you're taking this range in here from here to here, and you're utilizing it.
You can come on, Terry.
Yeah, you can come on and explain it a little bit if you'd like.
So on the, can you hear me?
Yes, I can hear
Yeah.
you.
So on the first entry, there's two daily fair value gaps stacked in the gray. So
Okay,
the short entry is at the CE of the first one, which would be the darker.
right here.
Yes.
Okay.
So that's the CE of the first daily gap. And then what I would be doing is looking for a range down to the Asia high or the London high.
Okay. So that would be in and around here.
The blue. So if you just act like you can't see the fib, if you look at the blue line, yes, that blue line you were just on, that's the Asia high.
Okay.
And then the next line would be further down would be the Asia low.
Okay. Are you talking? Oh, down in here.
No, I'll talk the purple box.
Oh, right here, right here. Okay, I see right here. Or this
So
one.
so that would be the entry at the CE part of the fair value gap, and then the targets would start going back to the Asia high, the London high, and then start seeking lows if I had runners.
Okay. All right. So you're basically playing the manipulation on the Asia range for the most part.
Yes.
Okay. All right. That makes sense. Yeah. So you're grabbing this. So I'm assuming this purple box is the Asia range.
Yes.
Okay. All right. So you're basically playing once price hits that higher time frame PD array, you're playing the delivery back into that range, and then you're targeting the high and the low, and then from there, depending on how it reacts, you're potentially looking to long back up higher into London highs, which would be this
Yes.
high in here. Okay, that makes sense. Okay, yeah, that makes sense. I'll actually there's a model. You know, I think one thing that I'm going to work on due diligently this week with you is there's a model that I want you to start looking at. I'll have to find it and I can kind of break it down for you to use that because you're trading from 3 to 5. There's a specific model that is kind of like this that uses the manipulation of Asia and kind of using that London model. And I think it's almost it's near what this is, but it's a little bit, I think, easier to understand. And I think it has a lot more detailed framework that you'll know exactly what to look for, and it'll help you know when to actually be a participant and when not to. So this week, what I'm going to try to do is I'm going to work with you and I'll message you and we'll try to go in and refine that a little bit and kind of get a little bit more simplicity to it. Because I think the more simple it is, the easier it is to execute on it, right? That act version, right? The more simple you could break it down into terms, the easier it is to act rather than react. But okay, that makes sense. I understand. You're basically playing the manipulation off of London in and around the Asia range. And then down here, next trade, daily long bias. So you're looking that price took these lows. So this is the Asia range. Price takes the lows. You're basically playing a turtle soup. And then from there, you're entering long, targeting, I'm assuming, the Asia highs. Stops 10 points just below the previous New York AM consequent encroachment. But then you're basically targeting these highs. And then you're targeting the buy side above the Asia highs from there. So that would be where you would basically look to target your buys. And then from there, once price goes lower, right, I'm assuming, so you got a long bias in here. Price took Asia highs and internal buy side liquidity. Shift short-term short bias did not cross over 4-hour fair value gap consequent encroachment. Price falls back into the London Asia range. Entry at rejection on London consequent encroachment. 15-minute fair value gap consequent encroachment. 1 hour fair value gap lower quarter. Stop loss 10 points. Okay, so from here, you're saying that once we took the buy side internally in here, price breaks back below. And on this is kind of identifying to you to go short. You come back in here and you're seeing price return back into that area on the 15-minute and overlapped with the 1 hour. And then you would go short in here, and then you would target lows as well. And the consequent encroachment of this range on the 1 hour. Okay, that makes sense. So really, you're looking to try to play both sides of the market. You're trying to play the manipulation and then potentially following that manipulation, read it, see if it really is manipulation, and then go on with the expansion. And if it doesn't seem as if it's manipulation, then catch the other side in the second leg of the expansion. Down here, daily short-term bias, or short bias, excuse me. Asia London expansion lower. London low did not make previous day's low. Short at Asia low, also 4-hour consequent encroachment would re-enter. Price went to Asia consequent encroachment. Target one was the London consequent encroachment. Target 2 was yesterday's low. So you see price reaching up into these 4-hour SIBIs in here. Stop is going to be, it looks like 10 points. You're entering once price comes back into that Asia low range. So you're entering off of the Asia. This is the Asia range. Price enters back into the low. These are also going to be considered as an order block. So you're using that as an order block potentially. And then you're going lower, targeting these lows as well. In here and in here. And then understanding this range also. Henry, you want to add anything to this?
I mean, it looks like it's a good framework. You're following order flow and participating inside the manipulation and utilizing those ranges. The one thing I'm most curious about is your stop loss placement, and what's the reasoning for just using 10 handles versus placing it based on some sort of P array?
So I use the 10 stop. And what I'll look at is earlier I would let a bad trade get worse by not by having my stop too far. So now I'm a little more comfortable if it stops me out the first time, but the trade is still good, valid. I'll re-enter at a better price. So just trying to, limit the stops and keep them from keeping me from expanding them too much.
Okay. I think
Yeah,
that makes sense. And I think with what I'll help you with this week, you'll have a better understanding too of where to define your risk, right? Rather than just always having that fixed 10 point, give yourself a range and then have something that you're looking at specifically in the chart to fix that risk at. I think that'll help too. I think, even though I get with the idea of having 10 points, not letting it get worse, I think the main point of defining risk is having a true invalidation point, right? What should my risk be set at that is going to not only stop me out and save me from having a worse loss, but also it should be the invalidation of it, right? My biggest thing is when I get stopped out on a trade, I want to see, does that mean that the trade idea was invalidated, right? The invalidation portion of it, right? It should protect you not only from also physical capital, but it should also protect you from the idea of potentially being on the wrong side of the market too many times. So I'll get with you this week and we can start to break down a little bit more of defining an actual point of where does that risk be set, right? Still have that 10 point to 20, 10 handle to 20 handle range, but then also have a very clear idea of defining risk, because sometimes that risk could also, if you have a clear point of invalidation, that point on some days could show 5 handles. 10 handles, 15 handles, 20 handles, and identifying what that defined point of invalidation is. And then from there, understanding that it could be 5 handles, it could be 10 handles, it could be 15 handles, it could be 20 handles. That's something that I'll get with you this week and we can potentially start to work on and kind of refine. But I understand exactly what you're coming from and utilizing that manipulation in and around London through those Asia ranges. Good model though.
Yeah.
I mean, it's a
Yeah,
unique model.
That's all good stuff. I think just the stop loss management is the area to work a little bit with there, just because it's important to remember too, your risk on a trade should be determined not by where your like how much you want to make or how much size you want to place on the trade, but where does that stop loss need to go? And so if you're placing your stop losses in terms of market structure or PD arrays that shouldn't be traded through in order for your trade to be supported, then you can know where that stop loss is and then adjust your position size in order to reflect that. And sometimes it means that if you're normally trading 1 mini, sometimes you will have to bring it down to 6 or 7 or 8 micros if your size is a little bit, or your stop loss is a little bit wider, and that's perfectly okay, because every time you take a trade and you're putting risk on, you're doing so with either expecting to have the trade play out in your favor, or you're paying a premium for information when it doesn't. And so you want your stop loss to be giving you some information about what's going on. It's not every time the stop loss hits, it doesn't always mean that it's going to be a reversal and you should reverse and go the other direction, but you want to gain something out of a stop loss. And so if you have a kind of an arbitrary stop loss just placed on a dollar amount or a random point amount and not on based on market structure, then you may actually find that you're taking unnecessary stop losses and not gathering the information that you need from that stop loss. You're paying for it when you stop out, and so you should get something out of what you're paying for. You should be collecting more information there and being able to utilize that for future decisions. But I think it's a great model otherwise, Terry.
Good stuff. I'll get with you this week too, and we can do some refinement on it. Alrighty, Mr. Aiden, I made a YouTube video with the commentary of my go-to bread and butter setup. If Carson Henry remembers my first training exercise, that setup is basically this model. He posted this link here if anyone wants to go watch it. Higher time frame analysis. So he notes the higher time frame bias and expects London to create the lower high of the day. On the lower time frame analysis, he notes the inefficiencies of the Asia range, and if the Asia range is larger than 50 handles, and search for an optimal trade entry to frame where your reversal might recur. Wait for price to sweep Asia high or low. If price doesn't, then you have no trade. Does Asia create an obvious low resistance price run? Time, he utilizes the London kill zone. Run happens usually between 1 a.m. and 4 a.m. New York local time. Frame your entry during the macros. Point of interest, he utilizes the OTE if Asia has a large range. Asia high or low, better if it's nested with a higher time frame PD array. Entry model, trader's discretion. You can use any PD array you like, being flexible with regards to how you're getting into the market. Risk management, ideally placing your stop above or below 2 PD arrays of current entry price level. Above swing highs or swing lows that sweep liquidity, as those areas are usually protected. 12 handle stop, also static. So he's looking between all of these three and making a decision based on what the chart's giving him. Trade management, trader's discretion, partials can be taken at swing lows where swing lows or highs where low resistance liquidity ends. Why I like this model is catered to trade that London manipulation swing in accordance to the daily range, either against or with the higher time frame bias. So it's almost a fast way to move your take profit and or your stop loss. Price sometimes does not give you an entry parameter and may run off without you. This happens quite often with London. Discipline to not chase. Utilize probability when getting an idea if your trade's likely to play out or in your favor, and create a threshold of if the probability is below example percentage, then regardless of how the trade looks, you do not enter. If there's a low resistance liquidity run, then increase your percentage by 10%. I altered this model to train cold and calculated trading. Do not think about what if, there's only this or that. It helps me stay grounded as a trader. I'll go back and I'll watch this video, Aiden, and I'll get back to you on some hand feedback of it. But this is also similar to what I'm going to try to talk to Terry about. You guys are both trading in and around that London time frame. So I'm thinking, with regards to, Terry, going back here, what I'd like to see you also do is have a specific criteria for entry with regards to, you might look at charts anywhere from 3 to 5, but maybe only from 3 to 4 you're looking for an entry. And then that if you don't have an entry from 3 to 4, don't trade. And that you're only utilizing that 4 to 5 o'clock window to just manage a trade and hold a trade. Something to note there. But I like this. I'll go back and I'll watch this video and I'll give you feedback in a ticket also. But good stuff. I've seen you play your model plenty of times, and I know that you're kind of defined there. Anything that you want to add, Henry?
No, I like this one. I think this is the or Aiden, is this the same model that you talk about with the completely like programmed model, no discretion? It's just the 15-minute approach, or is this a little different from that one? That's a different one. Okay. Okay. Well, I'll watch your video after as well, and then I'll get back to you on some more feedback. But I like the idea behind this.
Alrighty, Mr. Ranjan. Higher time frame analysis. He looks for monthly, weekly, daily, 4-hour, and hourly PD arrays, including external resistance liquidity in the form of old highs or old lows, and internal resistance liquidity with regards to fair value gaps on Sunday, and mark them out on a chart. All trades must be in the direction of the higher time frame bias. Lower time frame analysis. Once the narrative on the higher time frame is confirmed, I look for discount of the dealing range and supporting 1 hour, 15-minute PD arrays. I look for displacement on the 5-minute time frame for an entry. For POIs, he's utilizing the draw on liquidity, external resistance liquidity only. I only trade to the buy side or sell side in my models. He's trading during New York AM kill zone and aligned with the macro, either 1050 to 1010 or 1050 to 950 to 1010 or 1050 to 1110 from the models that he has backtested. Entry model, draw on liquidity, buy side or sell side needs to be identified first based on the higher time frame analysis. Look for an entry in the discount of the dealing range after a market structure shift, at least on a 5-minute time frame, ideally below the equilibrium. Best setups present in the OTE, so the 618 or the 705 of the dealing range. Take entry with breaker blocks or order blocks or fair value gaps. Unicorn setup will be the breaker and the fair value gap together. Risk management. Ideally, I do not want to risk more than 20 handles on NQ, mini or micro, or more than 5 handles on ES, mini or micro. I change to the risk base on the closure of the candle body or wait for 3 PD arrays to be violated. From my experience journaling, I have wicked out several times and then the trade goes in favor. Protective stops are placed below that fair value gap or mean threshold of the order block that is supporting the trade idea. For trade management, partials at each intermediate highs and lows, buy side liquidity, sell side liquidity, and leave one runner to terminus with stops at break even after TP1 is hit. Reflection process, journal every trade, including your emotions before, during, and after the trade. I use Notions to journal my entries and track my statistics. And then he's got examples down here. Higher time frame on a weekly, waiting for discount of the dealing range from the start of an energetic price run, which also aligns with the CE of the weekly consequent encroachment. So in here, he understands this fair value gap, taking the range from this low all the way to this high, understanding where that aligns, right? The equilibrium aligns with the consequent encroachment of this fair value gap. And then in here, same thing in here. So he's looking to see off of this range, price delivers into the equilibrium of it, trades off of it, expands off of it. He's using from this low to this high. He gets the equilibrium of it, utilizing an order block. Is that an order block there? Oh, no, fair value gap or volume imbalance. I can't read that from there. And then from there on a smaller time frame inside the kill zone, he's utilizing this breaker with a fair value gap in here also. So that unicorn setup, targeting the stop loss below the 5-minute fair value gap in here after it's already been delivered. Right here, also you can see that there is a fair value gap here. So he's using the low. And then from there, he's just trading a fixed in around 1.5 to 1 to 2. And he's targeting the external liquidity up here. Example 2, return to below midpoint of energetic price run OTE on the move of the daily fair value gap. Entry using the 5-minute breaker block in the New York AM kill zone with targets at buy side liquidity. So same thing here. He's got on a daily consequent encroachment drawn out. This was this week. From there, you can see price tap into there. Right, he's got a breaker block in here. He's utilizing the entire BISI as his fixed stop right here. So expecting price not to necessarily trade below this. And then he's targeting the buy side liquidity externally up here. And then his third example is in here where you've got a little tiny VISI delivering off of those daily time frames. And then from there, he's utilizing this external liquidity in here, all within the New York AM kill zone. You can see there's a little tiny fair value gap in there. Prices, and he's utilizing that as an entry, and he's placing a stop just below in there. Henry, you got any touches on this?
I like the model, the return to discount, the stop loss placement, and everything. I just want to clarify again on this, on the stop losses. There should be when you're calculating your risk. Let's all work on a shift in the perspective of, I don't want my stop to be more than 5 handles or 10 handles or 15 handles too. I want my stop to be at a place where it makes sense in terms of the market structure and the order flow, and you adjust your position size based on that. So like, let's say for example, if you're trading one mini, if that, the risk on that one mini should be relative to your account size, right? So you're risking, let's say, the same percentage of your account on each trade. So we'll give 1% as an example, right? So if you're going to trade one mini and the risk on a trade is 10 handles and that's 1% of your account size, if the next trade is a 20 handle risk, appropriate risk, you can't trade one mini on that because you're now risking 2% on it. So you need to adjust your position size on the trade, not the stop loss, but the position size. So if the market structure requires you to have a 20 handle risk, then you need to move your position size from 1 mini down to 5 micros. And there's nothing wrong with doing that. There's nothing wrong with trading micros. You have to manage your risk appropriately in terms of the market structure and the point where your trade is invalidated. So not based off of just a point amount or a dollar amount that you don't want to risk more than. It's what percentage of your account are you going to risk on this trade? Where does your stop loss in terms of the technicals need to be placed? And then your position size comes last based on that information.
So one clarifying question I have, Henry,
Yeah,
when this when many times when I look at my setups and I have like I do take these trades in Ninja with ATM strategy for my stop losses, and I move them, but how do we quickly, and you bring up a great point where I have been stopped out because I didn't place my stop loss at those invalidation point, and I went with a very hard 20 handle kind of a mindset, and even though the trade went in the favor, I got stopped out before that. So how do I quickly do that calculation on the position sizing, because the market moves so quickly that while you are mentally and physically placing your trade, sometimes it goes very quickly, and how do we do like a quick back of the envelope kind of a position sizing and ensure that the invalidation points are still right?
I think you could, well, there's a couple ways you could handle it. If you're trading through TradingView, like if you're linked up to TradingView, then you can use the position tool, the long or short position tool, in order to mark out your trade and then right click on it and do create limit order, and you can set your risk for the account and it will automatically calculate the position size for that trade. If you're trying to be a little bit quicker and just market order into a trade, then something that could be helpful to you is having something at your desk, like a cheat sheet of position sizes. So just have on it, this is my account size, this is my risk for the account, and then have just a list of handles. So like if it's a 5 handle risk, I can take this many micros. If it's 10 handle risk, I can take this many micros. If it's 15, I can take this many. And then you can kind of be looking at your chart and seeing where's my stop loss need to go, where is roughly the entry point, and whatever that is, you look at your cheat sheet really quick and say, okay, I can take this much size, and then you adjust your position size and enter from there.
Right. I think that's a very valid point. I'll definitely create that this weekend. Yep.
Yeah, good stuff. There's other things you could use too. I mean, you could have like an Excel sheet or something where you enter the stop loss in and it'll calculate for you. But if you're trying to do it a little bit more quickly, like if you are trying to market order into a trade, you don't necessarily have time to do that if you're executing on a lower time frame. So having a little cheat sheet or something you can look at really quickly to help you frame that risk is something that could be helpful.
Sure. Thank you.
Alrighty, good stuff.
Of course.
Miss Kate, I want to preface by saying that this is not a model that I came up with, and I've only been trading it in the last month or so. I've not been able to hold the trade to the weekly draw, and I'm in the process of incorporating more standard deviations and other personal touches to it. Regardless, it is the model I aspire to execute better in the future. I think it helps me to take fewer trades, fewer chances to get wrecked on suboptimal setups on lower time frames, take a bigger bite out of each trade. Why do all the hard work and analysis just to get 5 points out of the market like I used to? And here's how I approach it. Step 1, anticipate the draw on liquidity from monthly and weekly charts. Based on closures in the previous month and week, plus inefficiencies in liquidity above or below, I form an idea that where is the weekly candle might draw toward. Right, where's that likely ideal draw? Then I look for potential PD arrays above or below where manipulation could occur before going towards the draw on liquidity the other way. Step 2, avoid Mondays and use the economic calendar as a guide. This model relies heavily on weekly profile and weekly power of 3, so it's paramount to avoid Mondays. We have very little data as to how the week will play out prior to the completion of Monday candles. In addition to Mondays, I will also sit out on days with high impact news, as those days tend to be without high impact news, as those days tend to be choppy. Step 3, wait for manipulation and smart money reversal off of equal to or higher than 1 hour PD array. Knowing that the market will likely have a stop rate in order for pairing the real move, I will look for it to occur at one of the higher time frame PD arrays that I already identified as potential candidates in step 1. Based on ICT's weekly profile, this normally happens on Tuesday, Wednesday, or Thursday. Step 4, look for a change in state of direction or change in state of character, whatever you want to call it, to confirm that reversal. Right, that change in state of delivery after the manipulation, I will see the change in state of delivery on the higher time frames, 1 hour or higher, to confirm that reversal. Right, seeing where that displacement takes place. And then step 5 is the entry. I am a New York AM trader, so I typically look for entries during or after the 9:30 equities open or 10 a.m. new 4-hour candle open. I prefer to have a mini AMD on lower time frames, 5-minute, sub 5-minute before my entry, and those 2 times offer the most volatility outside of the 8:30 news. I also use daily profiles to help guide my entry. For example, if London already manipulated, then I could potentially look for New York continuation towards the draw on liquidity. Entry can be off any PD array as long as the risk to reward is palatable, at least 1 to 2. And then there are examples right here. So I'll go into here. So on a weekly time frame, here's the weekly draw on liquidity up here with the eye, where the eye is. Identifying that there's a BISI in here lined with this weekly high. She has the weekly open and the monthly open. Right. Price swept previous day's low and bounced from a daily BISI consequent encroachment. So you see we take opposing liquidity in there. We sweep it. Right. You have the change in state of delivery on the 1 hour, right? The displacement higher, changing the structure. And then you look for your entry in New York AM in here. Right. She's identifying the breaker on the 1 hour, stop below the midpoint of the breaker. And then from there, she's looking to see, she's drawing towards that weekly high. On a 15-minute, you can see in here, this is where her entry is, where her exit was. I saw her play this week. That was very good. Same thing on a weekly, right? Identifying that the weekly price action should expand up into here, right? We've got a volume imbalance on the daily. We've got from low to high. She understands where discount is, where sell side liquidity lies internally, where the weekly BISI is. Same thing in here. You have the change in state of delivery here on Wednesday, right? Sweeps the previous day's low and goes into a higher time frame area. And then you basically say, she notes that the change in state of delivery happened after market hours. So you look for an entry in the New York AM session on the next day. You go down in here, you can see from here, this is where she would look to see there's a BISI that aligns with her time frames and her macros inside those times, and then she's aiming for that draw, right, all the way up here. And then you can see in here, same thing, right? Idea is to hold all the way up here, but still getting that internal buy side liquidity from there. Same thing also. Weekly draws the previous week's high. You've got the weekly inefficiency and the order block. Price should drop down into here, into the daily and weekly imbalance, or as low as potentially the weekly order block. Same thing in here, right? You have the change in the state of delivery following price going into the weekly imbalance. Consequent encroachment, we shift off of it. There's no trading the day before NFP, so look for an entry post NFP release on Friday during New York AM. So you can see price in here revisits that volume imbalance on the daily. You've got the breaker in here with regards to the inefficiencies, just getting in here, utilizing this to not get fully filled, and then targeting up into the highs in here. And then you can see the entries also as well. Right, breaker, BISI combo, unicorn model, stop below the consequent encroachment. Down in here, you can see how she trails it up. She's able to take to this 4 standard deviation in here. Right? She's using this Judas swing lower, trading up into that standard deviation. Good stuff. Anything here you want to add, Henry?
I think this is really nice. Working toward capturing that weekly range. And it's good you're working off those higher time frame PDRs and then waiting for that hourly change in the state of delivery. Potentially defines the low a week for you and gives you a really good place to either risk off of if you can find an earlier entry opportunity, or it at least shapes the low, and so then you can just use market structure and your PDRs to define a trade from there. Really nice. I like the examples too.
I got something at the very end of this too. I think you'll like too. So once I go through all of these, I will. Alrighty, Miss Smithy. I do not have a defined model yet, though this exercise has helped a lot determining what I need to know in order to find, build, and learn one to fit me. I'm working on figuring out what I can readily see in price action, who I am as a trader, as far as the types of trades I would be more comfortable with executing and managing, when during the day and week it makes the most sense for me to trade and not to trade. I also haven't figured out how to use higher time frames very well yet, other than determining a bias I can learn my trades with, and watching how price interacts with higher time frame PDRs. That being said, my full trading plan is still under construction, as I am still self-reflecting to see what I'm able to see and then build from there. Higher time frame analysis, I'm not sure how much of this to use. Concerned that I only take trades aligned with higher time frame bias, I'm going to have to be at my computer a lot more hours than if I just look at a smaller scalp or two and shut it down for the day. I would like to find a setup that I can look for once or twice a day max and spend the rest of my day on family life. Lower time frame analysis, I think fair value gaps jump out at me, especially when they are on both sides. Then get broken through. Then I start to look around and see if there are any other PDRAs supporting a story about where price might go. POIs, fair value gaps, stop rates, change in character, market structure shift, and starting to see breaker blocks and order blocks. Time, I don't know an exact time. I tend to look at the New York pill zone and then when my kids nap around the New York PM silver bullet window. Entry model, if there is more than one PDRA, I like to enter at the place more likely to fill than give a higher risk to reward. So sometimes in the fair value gap and sometimes at the breaker block, whichever is closest to the direction I think price will go. Risk management, I'm not managing risk well. I have some technical difficulties with Tradeovate and trading view brackets. Trade management, I need to set some rules and have a plan. I feel my way through it and tend to jam my stop loss because I'm over leveraging or taking profit before my targets when I feel fear or that it's taking much longer than expected. I think as I continue to define my trading plan and backtest and build confidence in my model, I think that these behaviors will improve. Reflection, I generally can't remember the trades I've taken. I overtrade for sure, but I'm taking fewer trades than just a couple of weeks ago. I only journal some things sometimes. This is definitely an area I can improve on, especially once I get firm rules in place so I know that I'm doing what I'm supposed to be doing or if I'm letting my emotions interfere. So here are some examples, right? She understands equal highs were taken. She's got a breaker block in here, right? So after that's taken, on a 1 minute, she's got a 1 minute volume imbalance, and here she's entering in off of that inside the breaker, off of price delivering, off of this implied fair value gap, and then she's putting her stop above here, and then from there targeting a 1 to 2, right? I can tell that you're starting to see these things a little bit more clearly because all of this, to me, I can see clearly. That works. Example 2, same thing. So she's got a potential breaker in here. Sell side liquidity is taken. Price displaces higher. You have a BISI in here, aligned with a potential breaker block. Stop below the swing low, right here, the low that creates this BISI. She's entering in right as price delivers into there, 1 to 2, trades right to it. Same thing as well in here. You've got a breaker block, right? Buy stops rated up here. You have a low, a high. We take out the low, we take out the high, we take out the low. She's using the breaker block. From there, she's identifying too, you have an implied or an inverted fair value gap also as well. So as price trades off of it, retest it one more time. She's getting in here. She's aiming that 1 to 2, getting this low in here with the stop above the inverted fair value gap. So I can tell that you're starting to find a little bit. For sure, you like that idea of seeing some form of fair value gap inverted and then trying to use those breaker blocks. Henry, anything you want to add in here?
I think I mean, it seems like you've already worked through some of the 2022 model series, mentorship series, and we're going to be building out the schedule to do that that group study on that as well. All of these examples you show here are essentially the 2022 model. So believe it or not, I think you do have a model for yourself already, even though it seems like even though you may feel that you don't. And so it's just a matter of refining the times in which you're going to participate and building that focus on the higher time frame perspective. And the wonderful thing that is about the markets is that it's fractal in the sense that if you have a model that you can implement on a lower time frame, like a 1 minute or a 5 minute time frame, the area where that trade would set up, you can look for the exact same thing on a higher time frame. And so, like, if you see, let's say, for example, the 2022 model is like a run on stop losses, a shift in market structure, and then a return into a fair value gap. If that's something you could see on a 1 minute or a 5 minute time frame, you could see that same thing happen on a daily chart, and that fair value gap on the daily chart where you would enter from if you were taking the trade based on a daily time frame is the point of interest where you'd want to look for your lower time frame trade to develop. And so when price trades into that daily fair value gap, then you would just go into your lower time frame and look for the model to happen again. So you'd wait for a run on stops, wait for the shift in market structure, wait for a return into a fair value gap, and enter. So all of these trade examples you have here are essentially the 2022 model, and you're just taking it down in time frames. So we'll continue to work on that over the course of the next few weeks, and I'm sure that the group study will help too. But you do have a model here, and it's wonderful that you're starting to see these things, and it's clear in just your markups that you're making a lot of progress here, Sarah. So good stuff.
I will add, and I'm going to show you guys something. I have something for you guys with regards to my trading plan. I don't have the full thing. But Sarah, to your point, if I can sit here and I can do this really quick, I'm going to share my screen again, 1 second. All right, this is your model right here. Right, you're going to use this as a breaker block. And then you're also going to have a, this could be anywhere in here, right? This could be a inverted fair value gap, right? Right? Kind of like your model right there. Sometimes it stops at the high, sometimes it's above the inverted fair value gap, whatever the case is. But if I can easily sit here and write that out, that's a model, right? And you'll just learn to refine it. Now, I have something for you guys. So I am working on showing you guys my full trading plan, trying to get it in a manner where it is very easily digestible. And I can't give you it all today. I'm going to give you a little first piece of it as I continue to build this. But I enjoyed going through all of your guys' trading plans. I'm going to show you the first part of my trading plan. And it's just one part of my trading plan. And it's something, once you start to see how I go about my trading, you'll start to see the reason why I go about my trading is based on my plan and how black and white it really is. So I'm going to start by showing you guys how I go through identifying the weekly template, right? The weekly profile is crucial. As Kate noted in hers, identifying as traders, I have one job, and it's trying to identify where the weekly candle is, what the weekly candle is going to look like, right? If there's one thing I should stress, and I stress within my trading, is my job is to try to potentially anticipate one candle, right? I need to only anticipate one candle. I need to anticipate that weekly candle, right? Out of all the information that I gather, I need to try to identify on Sunday, what's that weekly candle going to look like on Friday? That is 90% of my job, right? That's 90% of the work. And utilizing the weekly profiles is crucial. So I'm going to share this and I'll post it in the Discord, but just know it's not my entire trading plan. It's just a very tiny piece of it because it goes so deep and there's so much that I'm looking at. It's hard for me to just, if I threw it all at you all at once, it would be very hard. And I'll go through and I'll have questions and you'll realize how simple it is, because as complex and as thorough as it all is, it's actually very simple. There's just a lot of pieces to it. So I'm going to give you guys today the first piece of it, right? So I'm going to go ahead and share this really quick on the screen. Right? So this is the weekly profile flow chart that I use, right? This is basically what's going through my head, right? I'm starting every single week with the economic calendar. If you start anywhere else, you're wrong. You're already off on a back foot, right? You start before you go into the charts. Before I go into the charts, I'm looking at the economic calendar, because identifying where high impact news events are being released are going to show you what potentially could be the weekly profile. So I'm always looking, okay, where are my high impact news events, right? First things first, where are my high impact news events, right? I do not trade on Mondays. There's no trading for me on Mondays. Why? Because one, there's usually not as much high impact news events, and without high impact news events, there's usually no expansion. Right there, boom. You want to know when the market's going to potentially likely to expand? It's in and around high impact news events. And a lot of that doesn't take place on Mondays. You also don't have enough data. There's very rarely, it happens, but very rarely, and you'll see me note it. So on Monday, 3 things could potentially happen. There's only 3 things that I'm looking for on Mondays. Does price engage a higher time frame, higher than or equal to a 4-hour PD array? If it does, do we have a change in state of delivery? If we do, then we could potentially see a classic expansion, and that Monday low or high could be susceptible to holding. And I have to know that, right? We've seen weeks previously, and there are weeks where even though there's not a technical profile for it, it's just an expansion week, which means Monday's the low, Friday's the high, or Monday's the high, Friday's the low, where it just there's no coming back in a sense. That happens only if on Monday you engage into a 4-hour or higher PD array and see a change in state of delivery. Then you could potentially expect it. Or if that does not happen, price will expand towards the higher time frame draw on liquidity. From there, I'm viewing that as unfavorable expansion, and I'm voiding the profile entirely, which means I'm very cautious going throughout the entire week, because that means that we could potentially be in a smaller range throughout the entirety of the week, right? If Monday hits and we go straight to where my higher time frame draw on liquidity is without returning to anything, I'm then expecting smaller ranges throughout the entire of the week. Odds are I'm voiding a lot of that throughout the week. If none of this happens, that means we consolidated and we're going into a state of consolidation. If we consolidate on Monday, I then will study Tuesday. On Tuesday, only two things I'm looking for. Do we engage a 4-hour or higher time frame PD array? If we do we see a change in state of delivery? If we do, then I'm looking for that to potentially be the low or the high of the week. I can play off that. That goes into my next plan, which I'm only giving you guys the start, or at least a piece of the start of it, right? From that moment, I can start to identify what that lower high of week might be. If we do not do this, if we do not engage this, or I do not see a change in state of delivery, odds are we're in consolidation. I'll study Wednesday. On Wednesday, do we engage a 4-hour or higher time frame PD array? If so, do we see a change in state of delivery? If so, I'm looking for that midweek reversal. Odds are I can utilize that to be the low or high of the week. If we consolidate, I'll study Thursday. If we consolidate on Monday, Tuesday, and Wednesday, which means I'm sitting here on Thursday and I see 3 straight days of consolidation, that means we have an internal range through Monday and Wednesday. Off of that internal range, if we engage outside of that range externally and then see a change in state of delivery, this is what happened this week, right? This is how this week might have been hard for you guys. It was not hard at all, if I'm being honest. It was very easy if you have something like this to follow. This is why this is your plan, and how you navigate the market does not start in the markets. It starts on how you follow the markets. Monday and Wednesday was straight internal range. There was no change in state of delivery on any of these days, no matter if it engaged. It might have engaged a 4-hour higher time frame PD array, but did you get a change in state of delivery? No. On Thursday, you have Monday through Wednesday's internal range. It engaged externally outside of that range. It manipulated Wednesday's low inside that daily and weekly BISI. From there, you did see that change in state of delivery on Thursday at that 8:30 news. From there, you're looking at a Thursday consolidation reversal. You can then treat Friday as an expansion day. And that's what would make me want to trade Fridays, right? If I do not find a setup here, even though I posted that on Thursday. I showed you guys, and in my commentary the night before, I literally said, look for a Thursday consolidation reversal. That was what I was looking for. We got that post 8:30 news. Price retraced into the midnight open. From there was a 30-second model off of that, and you could have potentially gotten. Kate took advantage of it. That was Kate's trade this week. That was also my trade this week. Obviously, entries were maybe a little bit different. You can hold till that. You can hold all the way to the daily high, and that's what I did. From there, if it remains internal and we do not take anything outside of Monday and Wednesday, I'm voiding the profile, and I'm not trading on Friday either. Odds are we consolidate for the whole week. Do you see how simple yet effective this is? Right? Notice how just by following this, last week was not confusing. Notice how I already in the back of my head knew. I didn't have to look at a chart to tell you what Thursday did, because it was so key to me. When you take this and you follow it, when we talk about following a trading plan, this is a piece of my trading plan. This isn't my entire trading plan. As I go through this, I start with Monday. I'm not looking to follow all of it every single week. this past week just happened to fit like a glove on Thursday. But if you look at something like this, I'm never stressed or confused in the market. I either know or I don't know. And I'm okay with that. I'm not necessarily confused. I just know that I don't know. And I know that in the future I will, because I have data to support it. If I don't know what Monday does, well, I do know what Monday will do, right? It's either going to engage that higher time frame PD array. And then from there, I might see a change in state of delivery. From there, I can do something with that data going on the next part of the, going into the next day and throughout the week. Okay. Well, what if it doesn't do that? And what if it just engages a higher time frame draw on liquidity? That's going to be considered unfavorable expansion. I'm going to avoid it, and I'm going to be cautious going into the next couple of days. I'm going to be a lot more hesitant. I'm going to lower my risk. I'm going to do all that sorts of stuff, right? Going back to the first one, what if it does engage a higher time frame PD rate and you do see a change in state of delivery? Well, then I know that we are set up for a potential large range week. Well, what if it just consolidates and it doesn't go into a higher time frame draw on liquidity and it doesn't go into a higher time frame PD array? Well, then we're going to be in what's called consolidation. And if from that moment, I'll study Tuesday. And it's wash, rinse, and repeat from there. Do we deliver into a higher time frame PD array? Yes. Do we see a change in state of delivery? Yes. Okay, from there, we go into considering classic expansion. Tuesday, higher of the week, lower of the week. What if we engage into a higher time frame PD rate, but we don't see a change in state of delivery? Then we're still consolidating. I'll study. Go into the next day. Wednesday, same thing. Right? It's only certain things. The market, what I have in front of you is the only thing that the market can do. This is the only thing that the market can do every single week. If you follow this every single week, every single day I'm watching. I don't trade Mondays, but guess what? The reason why I gather data on Mondays isn't just to see what it does with regards to how it looks. No, I'm asking myself, what did we do between these three things in here? I'm looking and I'm seeing, what did Monday do? After Monday, I'm checking one of these three off, always, every single time. One of these three will always get checked off. From there, I start to then navigate a narrative. What are my narratives? It's either these at the bottom, right? I'm either looking for a potential profile, I'm voiding the profile, or I'm moving on to the next day to study it. And I'm always coming every single day as the market trades, I'm coming up with some form of conclusion. There's always I always have a conclusion that I'm coming up with at the end of the day. Doesn't mean that I'm trading it, but I can go into the day and I can come up with a conclusion. That's why patience is so key. Carson, how were you able to wait until Thursday to trade and not get caught up in everything else? Because I had this. And I knew how to navigate it, because every single day, everything flowed into, right? This is a flow chart. Every single day it flowed into consolidation, study Tuesday, consolidation, study Wednesday. Even though we engaged into a higher time frame PD array, there was no change in state of delivery, which means you go into consolidation. It's still considered consolidation. So it was very easy for me to follow price action this week. As hard as it might have been, when you have something to follow to aid it, and you're not just trying to anticipate whatever it might be, and you're reacting off of it. If you have something to follow, right? Notice there's no Friday here. Why is there no Friday here? I wonder why there's no Friday here. Because the only reason I would favor trading Fridays is if this consolidation reversal hits. If so, and I didn't have room for it, but I will add it. I will add, if it is a consolidation reversal, then I will trade Fridays. Everything else, I'm just voiding it. Because if Monday consolidates, Tuesday consolidates, Wednesday consolidates, and Thursday consolidates, guess what? The probabilities of Friday consolidating is very high. The only time you're going to get some form of expansion run on Fridays is if Thursday does the reversal. Well, what if Wednesday or Tuesday does the reversal? Well, then odds are the 1 to 2 days following that, you'll expand, and guess what? Friday, you retrace back into the range. Not favorable. I'm set up for success in any way possible that it can go whatever direction. It doesn't matter because I just follow this. Right? Ron John said the change in state of delivery has to be on the hourly time frame or more than a 4-hour time frame. I prefer to see the change in state of delivery on a 4-hour, if we're being honest. As you start to grow, you can identify, because the 1 hour can still be kind of tricky. You can use the 1 hour, yes, but really, you wait for that 4 hour. But understand, it's tricky. You can use the 1 hour, but you really want to see what type of expansion that is in the change in state of delivery, right? And for me, my change in state of delivery is I'm looking for displacement. It was very clear on Thursday, that displacement. Boom, right there. When that 8:30 news hit, boom. There's my change in state of delivery. I need to wait for price to retrace into a discount, and then I can go into my entry model, right? What entry, and this isn't shown. This is another piece of my plan that I'll slowly work out to you guys. But what are my models, right? I use a 30-second model, I use the unicorn model, I use a power of 3 model, and I use an inverted fair value gap model, right? Those are my 4 models that I'm really working with, right? I have 4 models, and that's going to be utilized within my entry criteria. That's going to make me set up my risk. That's going to allow me to do all that stuff. But yes, you can use a 1 hour. You have to get good at understanding. It's not so much, is it the 1 hour or the 4 hour? It's both of them. It's how the chart looks. It's how that 1 hour looks going into that 4 hour. And it's also time. It's not just the time frame, but it's the time in which it's doing these things. Right? It's all about the time in which you're doing things. So it's not just always about the time frame, but it's always about it's also on top of that the time. You can use both hourly and 4 hour, but it also use what time it's occurring. Well, what time could that potentially be occurring? Go to that economic calendar. What's the very first thing on this flow chart? It's all there for you. It's all in front of you. There's no reason to stress and feel like you're going to miss moves. You know when the moves are going to happen, and the market always shows you. When did the market show me what was going to happen this week? Showed me at Wednesday by 9 o'clock. It showed me. Did I get fearful and did I get scared that I was going to miss that move at 8:30 when price displaced on Thursday? No. I was patient. I was waiting. I was watching price action, right? Carson, how did you know price wasn't going to necessarily? I'll even go into the charts for a second. Kate, real quick, said waiting like this prevents you from taking bad losses during unfavorable conditions and allows you the opportunity to capture a big chunk of the weekly range. Looking at something like this, you can understand, seeing my trade that I took on Thursday, how I was able to hold. How did I have so much conviction and confidence to hold for that entire daily range? This right here. But if I go into Thursday's price action really quick. If I go into Thursday's price action, right? On a 1 hour, to your point, Ron John, can you use this as a change in state of delivery on a 1 hour? Yes. On a 4 hour, you would have not necessarily gotten it. But the thing is just because there is not a BISI that is created on this, just because there's not a BISI that's created on this, let me go here. I'm still viewing this as a change in state of delivery. Because when this candle closes, it's still a change in state of delivery. I don't need the BISI to form on the 4 hour. That's not what I'm getting at. This is just clear expansion. Because when you go on a 1 hour, you can see that, yes, you're still creating a large expansion, right? So from there, what am I looking at? Well, when price starts to make a low to high, I need price to go into a discount. Well, what do you have? You have a breaker right here. You also have the midnight open. Right there. I wait. And I go on a 5-minute time frame. I'm waiting, right? I'm sitting here and I'm waiting. I have a breaker and I have the midnight open. All below discount. All in discount, excuse me. I'm waiting. Price wants to run, it can run without me. I'm okay with that. Now just watch. Price creates a SIBI right here. How am I able to be patient and watch? Price creates a SIBI right here. I'm watching candle closure. Have we closed above this SIBI yet? No. Okay, price can continue going lower. Once we get below this high or below this low, now I'm looking at this and it's either, and to me, it's going to do one of two things. It's either going to come back above here and I can use an entry right there. Or if it doesn't do that and it remains below this, then I'm waiting for price to push down into here and then I can get an entry. Two things. That's all I'm waiting for. Two things. Price dips into this area. I'm now going to go into a 30-second time frame. Hold on. Right? Now I'm in on a 30-second time frame. I'm waiting. I need price to displace through this midnight open. Now watch this. Watch this. Watch this. Watch this. Watch real closely, right? This is key. BISI. I don't enter in on this BISI. Institutional order flow entry right here. You're not using that as an entry. You're waiting to see what it does following that, right? BISI is now created. We from one BISI created another BISI where on top of and through the midnight open and the top half of this breaker block. Look at how the 30-second candles respected the entire breaker block. Right there. That is where I entered on Thursday. I entered on this candle, this exact 30-second candle. Where did my stop loss go? Below this BISI. Right there. Where is my take profit? The entire take profit. Where was my entire take profit? Not partialing a single thing. And then you let the magic happen. And then you let the randomness unfold. Is my stop at break even here? Yes. Does this scare me? No, because there's a 5-minute and 15-minute BISI here too. I'm watching this on a 5-minute and 15-minute, and I'm watching the inefficiencies that are created in here, and I'm just watching the closure. Do we remain above the consequent encroachment of it? Yes, we do. This is that 5-minute SIBI that kept me from getting in early. We close above it. My stop goes at this low in here. Watch how we use this as support. Running lows in here. Is this scaring me? No. Because I'm looking at higher time frame and we're still above this 5-minute BISI or SIBI. Using it as an inversion, and we run higher. Does this scare me in here? No. We're still just running within the macro, the lows. Right? There's a 5-minute, 15-minute BISI in here that I'm watching, still holding it. Now we start to run. You can start to see that change in state of delivery. Stop is still down here. On a 5-minute, 15-minute, there's BISIs that you can find and utilize in here to watch the closure. So this doesn't scare you. It's just delivering into it. And then it marks you right there. Right? How was I able to do something like this without stressing? Well, it's going to be a little bit of stressful when you start to do it up front. When you start to do full pulls like this, it's going to be stressful. But I had this. Where did I get my conviction from? Where was the conviction to hold it? How did I know I was going to be willing to hold it? Because of this. Right? My plan. So I just wanted to share that with you guys. That's something that I will post in the Discord as well. And I'm going to try to formulate visuals like this to really kind of show you guys what it's like to get inside my head. And now we will go on into the exercise for this week. Exercise 25. This exercise is focused on the manipulation and expansion in and around the 10 a.m. and or 2 p.m. Eastern Standard Time 4-hour candles. Please, we want you to note the 10 a.m. or 2 p.m. open price. Please note that the manipulation above or below if you're trying to be a buyer or seller. Please note the manipulation above or below that opening price, and then note the expansion through the opening price following the manipulation, and then find an entry in and around the opening price of whatever 4-hour candle you choose, whether it be the 10 a.m. or 2 p.m. or both. It is NFP protocol week, so trades are only accepted through Wednesday until noon. Your account balance should be rolled over from the previous exercise, exercise 23, 2 trades maximum for the week. If you're currently in profit, risk 0.5%. Or if you're just starting an account, risk 0.5%. If you win your first trade, stop. If you go break even or lose your first trade, go back in at 0.25%. Risk 0.25% if you are currently in drawdown. If you win your first trade, stop. If you go break even or lose your first trade, you can go back in at another 0.25%. We want you to at least target 5 handles on ES, 10 pips on Forex, 20 handles on NQ, and you should always be using a stop loss. Make sure that you journal your trades outlined below. And that is it. Any questions, comments, or concerns on this? Good. Well, I think that puts a wrap on this one. Henry, you got any questions, comments, concerns? Anybody
That's
else?
it for me. Look forward to a great week. Jam-packed week on my calendar.
All right. Well, I think that's a wrap. No rants from me today. No psychological rants from me today. I don't really have anything. But I think that's it. You know what needs to be done. You know the right things and the wrong things. Patience, patience, patience. Appreciate you guys. We'll be in touch in the Discord. We've got a couple things lined up for the community. We're trying to figure out a schedule for the focus group. Once we can have a schedule,
we should get that going in March.
So once we have a, do I change my weekly analysis for NFP week? Yes. I just view the weekly template starting off as seek and destroy. So I'll post it in there. The seek and destroy template is in there, and it's basically you look for previous day's highs and lows to be taken, and then you look for the return back into the range. So Monday's highs and lows, look for them both to potentially be taken and then return back into the range. Tuesday's highs and lows, you know, it literally looks like this. Really quick, I'll show you. This is literally the template for an FP week. It's literally kind of what it looks like. But my analysis does not change. The only thing that changes is I do not try to hold for daily ranges. I am very short with my trades. If I choose to trade, I am in and out. I'm only going to be playing session liquidity, and I'm a lot more keen to take partials and move my stop to break even quickly. And I do note that PD arrays are a lot more susceptible to be invalidated because the price only seeks and destroys highs and lows. Thanks a lot. Is your 75 hard coming to a close? Yes, I have 19 more days. I have exactly 19 more days for 75 hard. So I'm very excited. People say that the first month is hardest. That is not true. The last month is by far the hardest. I can tell you that right now. Very anxious to be done. I feel amazing. I feel like I deserve a drink, but I don't yet. So I'm waiting there. The last month is by far the hardest just because you feel so good. You've accomplished so much. And it's just like anything else in life. The closer you get to something, the longer it feels. And so it's definitely testing my patience. But I've got 19 more days, a little under 3 weeks. And then after that, I'll be able to go celebrate up in Charlotte with Henry. And that's kind of keeping me sane. So knowing that's been kind of like that's been like the treat at the end of it all, just dangling in front of me, is being able to go visit Henry and go look at Charlotte. So the 29th, the weekend of the 29th. So our call on March 31st will actually be done. I will not be here in the seat. I will actually be sitting right next to Henry in Charlotte, and it'll just be me and him together on the same call. We'll still do our call. I just won't be here in front of my screens. I will be in front of his. So excited for that. Other than that, we're rocking and rolling. Be safe this week.
All right, we'll see you in the Discord. We'll be back to regular streams and all of that. We'll take a look at the exercise this week on some of the live streams as well, and we'll get started on that group exercise in March as well, going through the 2022 mentorship. Be safe, be responsible. We'll see you tomorrow.
Peace, guys.